Warm welcome to another week ahead video, guys. This week's video will cover the trading week running from the 10th to the 14th of May 2021, and our main focus in this upcoming week will definitely be inflation, with the upcoming CPI print for the US due on Wednesday. Now, turning to last week Friday, or this week Friday rather, the term YIKES really expresses the way that we felt about that NFP print that we saw on Friday. It was a monster of a miss coming out of that NFP headline print. Markets anticipating a print of 978,000, of course, and we came in at 266, well below the market's minimum expectation. Now, when you see these types of big divergences between the expectations the markets were looking for and the actual data, it might have been more candid to have called last week's NFP estimates from various market participants as guesses rather than forecasts, just given the sheer size of the miss we've had. Now, how did the markets take this news? Took it pretty much as one would have anticipated, with a little bit of a surprise twist at the end. If we take a look at equities, of course, equities rammed to the upside. We saw that the S&P 500 saw upside across the board in all sectors, as the equity markets basically saw the miss in NFP as a clear sign that ultra easy policy is here to stay for a very long time. The US dollar saw a sizable push lower as well after the report, as Eurodollar futures, if we just quickly get this on the screen, Eurodollar futures in terms of policy normalization started to price out the probabilities of a rate hike, a first rate hike by March 2023, as the miss in the jobs data saw more reasons, of course, for policy normalization to remain further away than the rates market were previously anticipating or implying. We also saw that the September 2023 contract implied just over 2 hikes. So the fact that we saw Eurodollar futures pushing higher as policy normalization expectations were pushed out further, that explained the move that we had to the downside in the US dollar. And there was also some impact from real yields as well, but we'll discuss that in a second. Now, the surprising one came into US 10-year bond yields. Now, US 10-year bond yields moved lower on the back of the report initially, as one would expect, but we saw a very strong push back to the upside, with US 10-year making a round trip from 1.57 pre-NFP to finish slightly higher at 1.58 at Friday's close. Now, we had a couple of questions in the Q&A that we received after the event as to why US 10-year yields made such a strong U-turn higher despite the disappointing data, and secondly, why the US dollar didn't follow yields higher as it started to recover. Now, in terms of the second question, it's very important to keep in mind that when we look at something like yield differentials, even though it is a very important driver for currencies, it's not the only driver for currency. So the fact that we had yields recovering, but we didn't see the dollar follow suit. Yes, yields have been a key driver for the dollar, but it hasn't been the only driver. So the fact that Eurodollar futures has been pushing higher is one reason to explain the fact why the dollar didn't catch up to that move to the upside in US yields. And the other one to keep in mind is, of course, the correlation to real yields. If we take a look at this chart, we can see the dollar in red. We can see real yields using a proxy here, tips for real yields inverted, of course. And we saw that very sharp drop to the downside, almost getting back down to the January levels, where the dollar, of course, was at its cycle low. So the fact that real yields have been falling recently is one of the key reasons why we've seen a lagging price action in the US dollar, of course, as inflation expectations outpaced the move we had in something like nominal bond yields. So real yields arguably was the bigger driver for the dollar in Friday's session, as opposed to nominal yields. So always just important to keep that in mind. Now, when it comes back to US 10-year bond yields, then, why did we see such a sharp U-turn? And the answer for this is really inflation. After the report, we actually saw US 5-year as well as 10-year inflation expectations ramping to the upside on Friday, which was a key driver for that move, in our opinion, that we saw in US 10-year yields. Now, even though the headline NFP had a massive miss, we saw another surprise coming out from the data, and that was the sizable move higher that we had in the earnings data. Now, the higher earnings basically coincided with the Q1 employment cost index, which rose to the highest level since 2008, showing that there's been a lot of upside pressure in terms of wages. Now, the rise in earnings basically confirmed speculation from market participants for a while now that factors such as virus fears and, of course, that massive fiscal stimulus support has meant that those workers that used to just work hourly or low wages doesn't really have a lot of incentive right now to get back into the workforce. So the jump that we had in the earnings data on Friday saw market expectations for inflation push higher as it saw a real risk of wage cost price pressures ramping higher in months ahead, as it seems like companies will now need to start really looking to lift wages to try and incentivize workers to come back into the labor market. Similarly, in a recent Bloomberg article, it was noted that during the recent earnings season that we've just had, the earnings releases, that various companies reported that they just can't find or entice enough workers to join the labor market right now. Now, this view was also expressed in the recent Beige Book from the Fed release, which noted that some companies had already started to actually raise their wages and include something like sign-up bonuses just to try and find willing workers and willing job takers. So even though this week's upcoming CPI print might not be that important for policy normalization expectations, because the Fed has made it very clear, of course, that they're not going to move on this Q2 data, it could be more interesting for things like inflation expectations, and thus very interesting for US 10-year bond yields. So turning then to the week ahead, looking at this incoming CPI print, it is true that the CPI print might be, like we said, be brushed off as it relates back to policy normalization, because the Fed has made it very, very clear, abundantly clear, that they will not be bothered by the Q2 inflation data, because that is expected to move higher due to mostly transitory base effects and, of course, bottlenecks that they've mentioned quite a lot recently. Now, interestingly, Nordea Investment Bank, who currently thinks that inflation could prove to be more sticky and less transitory than the Fed currently expects, did some research on bottlenecks and how that can impact inflation, and they found that it could affect inflation over an 18-month window or period, and historically it hasn't just magically disappeared overnight. So inflation pressures are definitely rising right now. Whether we consider the rapid rise in commodity prices with the steepest backwardation in 14 years, or whether we consider the vast number of companies that have complained about the shortage of materials and subsequent, obviously, higher input prices. It's also been clear when we consider the rapid rise in prices paid. If we take a look at this graph with the ISM weighted prices paid measure versus US CPI core inflation year over year, or the fact that numerous consumer facing companies have been warning that supply shortages as well as logistical logjams may force them to start raising prices, according to a recent Bloomberg article. But the question, of course, remains just how transitory all of these price pressures will be. So on that note then, what can we expect from this week's CPI print? Well, markets are looking for headline CPI year over year to print at 3.6%, and for the core CPI year over year measure to print at 2.3%. Now, if we see a print close to or above the market's maximum expectations, that could give inflation expectations once again a further lift, and would also be expected to put upside pressure in the longer dated bond yields like US 10-year. Now, given the Fed has assured the markets that they are purposefully staying behind the curve, any jump in CPI which provides upside for US 10-year bond yields might not be as supportive for the US dollar. And the answer for that once again comes back to real yields. Remember that real yields have been steadily falling over the recent weeks and has been a key driver for US dollar weakness, alongside the strength that we've had or seen obviously in something like gold. So even though gold is affected by nominal bond yields, the bigger driver from an inverse correlation for something like gold is always going to be your real yields as opposed to nominal yields. So the fact that we've been seeing that drifting lower has been a key driver for the dollar to the downside. And if we look at something like the CPI print coming up, a solid CPI print which sees inflation expectations outpacing once again the upside in longer dated yields, will place further downside pressure on real yields, which actually could be dollar negative despite seeing a possible positive CPI print. So that's something very important to keep in mind. So it'll be important not only to measure how US 10-year bond yields react to the CPI print, but also how inflation expectations and then of course real yields respond to that as well. Now, any moves higher in US 10-year bond yields should provide upside pressure on something like dollar yen, which has been very sensitive, of course, to moves in US 10-year bond yields. However, a further drop in real yields would also mean that potential upside could be more limited for the pair, depending, of course, on what the overall risk appetite is like at the time. So turning to a potential trading plan, we've got really two scenarios playing out. Firstly is potential bullish outcomes for US 10-year bond yields, and then bearish outcomes. So starting with the bullish ones, we're going to be looking for CPI printing above maximum expectations, retail sales for Friday printing above maximum expectations. We've also got US 10-year and 30-year bond auctions coming up as well, so any strong disappointment in that can also be positive, of course, for US 10-year bond yields. And then if we see an overall positive risk tone on the global front, that should also be positive. Now, looking at the potential asset impact, the dollar, obviously, like we said, a key focus here will be what happens to real yields. Even if we do see US 10-year pushing to the upside, we might see more muted price action coming out of the dollar itself. And for that reason, turning to something like USD yen as well as USD CAD, we obviously still do maintain a medium-term upside bias for USD yen and a medium-term downside bias for USD CAD. And if we take a look at these two outcomes, we do think that there might be some potential asymmetry in the week ahead, meaning that a long position in dollar yen and a short position in USD CAD could be looking attractive despite either outcomes we get. If we take a look at the above bullish outcomes, of course, for US 10-year yields, like we said, CPI printing positively might not be positive for the dollar due to a move lower, potential move lower in something like real yields. But if US 10-year moves higher, we could of course see some upside in dollar yen, which has been very positive. Positively correlated to US 10-year bond yields. And if the dollar moves more sideways, that should be more positive for USD CAD downside, of course, as any type of sideways or a lagging price action in the dollar could see USD CAD drifting lower with that strong medium-term downside bias in the CAD. A beat in retail sales should be more positive across the board for US yields as well as the dollar. That could, of course, see some upside in USD yen, but also some upside in USD CAD. In terms of the auctions, only expecting that really to impact the US 10-year as well as USD yen. And of course, in terms of overall global risk tone, if we see US 10-year pushing up but the dollar pushing lower on the back of that, we would still anticipate upside for USD yen. Might just be more marginal upside even if the dollar moves lower on the back of that, because again, one of the stronger correlations to the pair has been moves in yields as opposed to moves in the US dollar. Coming then to potential bearish outcomes, a print below minimum expectations for CPI is expected to be weak. Price action for US 10-year yields also weaker for the dollar, obviously depending on what happens to real yields. If yields moves lower, we also anticipate that to see USD yen pushing lower, but this again sets up opportunity for the USD CAD, because if we do see the dollar pushing lower on the back of that, that should just give us further momentum to the downside for USD CAD's medium-term downside bias. A similar possible reaction there for a miss in retail sales. Similar possible reaction there for a very solid bid to cover ratio in that 10 and 30-year bond auctions, if that should happen. And the bigger problem for both USD yen as well as USD CAD in the week ahead will be a very dismal overall global risk tone. If that should occur, that is expected to see downside in yields. That should be more supportive for the dollar, because both of these is a safe haven. That should arguably be more of a sideways price action on the dollar yen, and that should see more upside for the USD CAD. But overall, there does look to be some asymmetry for dollar yen upside and USD CAD downside in the week ahead. So guys, that's everything from our side. We hope you guys will have a fantastic trading week ahead. As always, any questions, please don't hesitate to let us know.